Started, we have a great opportunity and a great event this week. It's a little bit unusual along a number of dimensions. We have Larry Smith today, who is a graduate of the University of Florida, which is always the case. But what's kind of unique is that Larry was going to come into town and do something and agreed to talk to some people after the speaker who was scheduled for today to come, and figured that was scheduled, canceled at the last minute. So Larry came in and landed in Jacksonville about an hour and 45 minutes ago and came straight here. So we really appreciate what he has stepped out and did for us today. And also he has very exceptional credentials. Larry started out in fixed income at J.P. Morgan and worked in J.P. Morgan Asset Management. Then ultimately was the Chief Investment Officer of Credit Suisse Asset Management, which is quite an accomplishment and quite a position. $300 billion? Yeah, so he oversaw $300 billion in assets, and then co-founded Third Wave Investors, Third Wave Global Investors, a hedge fund, and he's going to tell us about that today. And you'll take questions at any time?
Anytime.
Great.
All right.
Thank you, Larry.
Thank you. The only thing I want to apologize up front is my voice. You can hear it's quite gravelly. So if you can't hear me, please just wave your hands, and it's sort of no use me coming all the way down here if people can't hear me. So let me know if you can't hear me. It's a privilege and a pleasure to be back here. It's also a bit bittersweet. I'm sad that I haven't been back here since I graduated. I graduated in 1979. That was a long time ago, and this place was very different. There were nowhere near as many students. There were nowhere near as many buildings. And it's fun to come back and see the growth of the university, and as well as keep track of how well the university is doing in terms of the ratings, which keep on going up and up, which is really terrific. So I'm going to go through a bunch of stuff today. The presentation is structured in two halves. The first half is my fund, my product, how I look at the world, how I invest money. Now, I tried to boil things down to have relatively few pages, so I'm not going to cover every point, but I am going to cover a lot of points. And if anybody's interested in one particular point, please raise your hand and say, can you go into that more? Or ask specific questions about something that may be up there. The second half of the presentation is about the outlook. The outlook is scary right now, so I do want to touch on that also. So those are the two halves. Right? Again, by way of background, when I left here in 1979, at the behest of a business school professor, I went out to Berkeley for my graduate school. I basically finished my MBA in a year and took all the PhD courses in finance my second year, and then got a job at J.P. Morgan and decided to get out of the academic world and get into the practical world, if you will. And I was there for 18 years, long time. I knew it was time to leave when my mother said to me at one point, isn't it amazing in this day and age that you're going to end up staying at one firm for your whole career? And 2 months later, I left J.P. Morgan after 18 years. So much for predictions by our parents. So after that, I ended up going over to Credit Suisse Asset Management. Let me just step back. The great thing about my time at J.P. Morgan was that I did lots of different things. I am intellectually ADD. I can't remain focused on one thing. I love to do different things. So it was not right for me to go into a job where all I did was something very narrow for a very long period of time. What was right for me is to go to a large place that does lots of different things, to allow me to learn what the world looks like and how the world works, and to give me the opportunity to really put my foot into a number of different types of things. So got out of Berkeley in 1981. I was a new wave quant, ready to tackle the world. At the time, quants were not particularly embraced. In fixed income portfolios, they used average maturity to measure interest rate risk. As remarkable as that may sound for any of you who have studied fixed income, this is 1981. This isn't 1961. So a lot of low-hanging fruit, a lot of easy things to do, but also at the same time a lot of challenges, not only mathematically and in the markets, but challenges organizationally. How do you convince all of these people who have been successful for a long time, who have done things a certain way, that there's a better way? And that was a real challenge for me because when you're in school, it's all about who's right and who's wrong. Figure out Black-Scholes, figure out the hedge ratios over time. There's a right answer and there's a wrong answer. And when you get into work, there's not a right answer and a wrong answer. There's a better answer and a lesser answer. But at the end of the day, the people who win are the people who can sell their ideas to other people, both internally or externally to clients. One of the fortunate things that happened to me was the advent of a product called bond immunization. Bond immunization was a way of using all of this newfangled math to match assets to liabilities. So pension plans have liabilities in the future. How do we put together a portfolio that effectively defeases those cash flows? The whole field of bond immunization came up. And that was a wonderful opportunity for me, because here it was 1984. I was 26 years, 1982, I was 24 years old. And they needed somebody who spoke quant and spoke English. And that's the other set of skills that I can't emphasize strongly enough. If you just want to be a quant and you're not able to communicate, you're just not going to be as successful as you will be if you could speak both languages. And I say that obviously figuratively, but nonetheless, the point's an important one here, which is figure out something and then figure out how to communicate it. Those are two skills that both are necessary in the business world. So this new product area came along, and the people at JP Morgan said, hey, this is a growth area. We could bring in some business. We need somebody who understands a quant and also could speak to clients and probably also can figure out what's happening in the markets. And a couple of us got plucked into this area, and we grew it into the biggest bond immunization shop in the business. Back then, it was big numbers. We were up to $6 billion in 3 years, which seemed like a lot of money back then. The business has just grown exponentially since then. Ended up taking over the fixed income group. I was co-head of the fixed income group from 1990 to 1994, overseeing $65 billion at the time. We were the biggest fixed income group in the business. We were bigger than PIMCO. We had better performance than PIMCO. We had more net new business than PIMCO. That's changed dramatically too. My hat's off to PIMCO and their success, and Bill Gross and all of his insights through the years. After that, the ADD thing came up again, and somebody tapped me on the shoulder and they said, you know, if you take a look at JP Morgan broadly, JP Morgan Investment Management, which at the time was considered the number one actively managed, institutionally oriented investment management firm. Okay. So, you know, all of our clients, all of the blue chip clients, whether it was, you know, the auto companies, IBM, every major corporation in America was a client of JP Morgan Investment Management. We managed an awful lot of money. Somebody tapped me on the shoulder and they said, you know, funny things happened around here. That if you take a look at this organization, what you'll find is that we have all these different products, because in order to be in business, you have to have a product to sell. So we created products to sell to our clients. We have large cap U.S. equities. We have small cap U.S. equities. We have mid cap U.S. equities. We have U.S. fixed income. We have IFA, international equities. We have emerging markets, right? If you take a look at global fixed income, you take a look at all of these products at JP Morgan, there was one thing that they all had in common, which was that the organization did things very well bottoms up and did things less than very well tops down. Now, you think about an international equity effort. They had decisions to make with regard to country allocation up here. They had decisions to make down here with regard to which stock do I pick in the technology sector in Japan. They did the bottoms up things well. They did the tops down things poorly. Lo and behold, you looked in fixed income, you found a pretty similar thing. We did a great job in picking credits and figuring out which mortgage to buy, but those duration decisions, you know, weren't done as well as they needed to be done. So somebody tapped me on the shoulder, said, we're taking you out of fixed income, and we're going to create a new position called Global Head of Asset Allocation. Those of you who may be familiar with Barton Biggs, I was basically the Barton Biggs at JP Morgan. It was my responsibility to try and figure out what the tops-down trends would be over the next several years so that we can position portfolios better and so that clients could get the guidance that they needed to improve their portfolios. I did that for 5 years. I built up another book of business, which oddly enough turned out to be $6 billion again. And then I got the call from Credit Suisse to become their global chief investment officer. Credit Suisse was a mess. It was a bunch of small asset management companies that all of a sudden, with a whisk of a wand, somebody said, hey, let's put them all under one roof. Let's create something called Credit Suisse Asset Management and form a global asset management company. So they were like this for about 2 years. It ended up being 17 different asset management companies all stuck together. And you know what? They didn't want to be stuck together. Most of them didn't want to work for a Swiss bank, but they were working for a Swiss bank. So I got tapped on the shoulder. I got pulled out of JP Morgan. I got hired over at Credit Suisse. My job was to create one organization, one culture, one investment discipline, one overarching investment philosophy. And that's what I did for 4 years, is try and take this firm of highly disparate products and create one organization. So with that, I left in 2003. Took some time off to recharge my batteries, which desperately needed to be recharged. The political environment at Credit Suisse was brutal. And I grew up at J.P. Morgan, where J.P. Morgan was a very polite place. The rest of the world was not. So that was a bit of a rude awakening for me. But I survived. And after some time off after Credit Suisse, I decided to open up a hedge fund. The reason why I wanted to open up a hedge fund was very simple. If you manage money in a so-called long-only way, your target clients are generally going to require a longer track record, 3 years, 5 years, whatever the number tends to be. If you manage money in a hedge fund, it's boom and bust. Right? If we got out of the gate and had poor performance, we wouldn't have raised any money. But I knew if we got out of the gate and had good performance, which fortunately we did, we'd be able to raise money and have a viable business. And the last thing about hedge funds is the fee structure in hedge funds can best be described as being usurious. It is not sensible. A friend of mine named Cliff Asness, who created AQR, is having some hard times lately, but still is one of the biggest hedge fund and asset management firms in what they do in the quantitative area, once described a hedge fund as an asset class based around a fee structure. Because it really doesn't take you into asset classes, it takes you into strategies. But what really differentiates it is the fee structure, which, for once in my life, I wanted to be on the right side of that equation. So 4 years later, all was going well. This is a tough year. And I know I'm not alone in saying that, but this is one tough year. Been in the business 27 years. I've never seen a market environment like this. So with that, we'll come back to that. But that's the rambling preamble that I wanted to throw out there ahead of time so that at least you know who I was. And sometimes I do describe myself as a reformed quant. I feel passionately about quantitative tools and the use of quantitative tools to make money in the marketplace. At the same time, I fully recognize that there are things that can't fit into a box. And there are great things about quantitative tools, the discipline they add, the sophistication they add, the efficiency they add. I can't do those calculations around the world instantaneously like my PC can. But at the same time, they're also pretty rigid. And they can't adapt to things like, a head of a central bank in Europe who seems to be out to lunch. So, excuse me, all of my investment processes always combined, hopefully, the best of the quantitative world with the discretionary world and puts them together in a very systematic and disciplined way. Okay, I guess I just push this down to go forward. And I don't know how well people can see these charts, these pages. Oh, you have hard copy. Well, it doesn't look like everybody has hard copy. All right. So you know what? I'll go through these and try and repeat sort of the salient points. It's probably too much.
Problem is it's hard to get just the light off.
Yeah. There we go. Perfect. Okay, it's a little bit better. But the people in the back, it's probably not going to be as visible. So what are we trying to do? A hedge fund is all about creating an absolute return process and delivering absolute returns to people, which means not going in and saying, hey, the S&P is down 40, but we're only down 10, which happens to be the case this year. Okay? It means producing positive returns each and every year to the extent that that's possible. Of course, it's really not possible. Nobody can do that each and every year, and you're going to stumble at some point along the way. But what you hope to do is stumble in a way that's uncorrelated with the overall markets. Because this is the whole sales pitch behind alternative investments, which is smart people making a lot of money. They're going to figure out how to make us money, and they're going to diversify the rest of my portfolio. So we want to focus on absolute returns, make money in an absolute return space, and do it with a very low correlation to the traditional marketplaces. There's been a sea change in the hedge fund world, which is that years ago the hedge fund world was all about, he's smart, let's give him some money and see how he does. And now the hedge fund world has become more institutionalized. That means many different things, but one of the things that it means is that people are demanding more transparency. They want to know not only what the decisions you made were, but how did you make them? How did you come to make that decision? Because if they don't know that, and you have a bad year, they really don't have a whole lot to rest their hat on. But if they buy into your investment process and believe in how you make decisions, they're much more willing to ride it out when you do have a bad year. So transparency, letting them know how we make decisions, what the recent decisions that we've made are, all of that is what I've always done and what I'm doing at Third Wave Global. You'll hear a lot of people talk about SEC registration and what an evil it is to the hedge fund world. I registered day one before I even had to because, again, I have nothing to hide. So investment philosophy, very much fundamentally driven. We use quant tools, but the mainstay of those quant tools rests upon some economic logic. So instead of just going out there and throwing a bunch of stuff against the wall and seeing what sticks, what we prefer to do is take a step back and say, okay, what should this relationship be? There's some theoretical precept for that relationship, and then we'll check things empirically. If you don't do that, then chances are 1 out of every 20 things you check will be significant at the 5% level. It's a bad thing. It's called data mining, and what ends up happening is that your back tests always look good, but as soon as you pull the trigger, it doesn't look so good. Okay, risk management's important. I'll talk about that in just a moment. Blah, blah, blah. These are just the people that are here. And let me just say, one of the things that I learned at Credit Suisse, which I didn't learn incidentally at JP Morgan, is that investment performance really is not a function of the size of your staff. The investment markets really are unique. You know, if you want to sell more goods, you need more salesmen. But if you want better investment performance, ultimately it's the quality of your ideas and not the quantity of your ideas that will make a difference to your portfolio. And that's a really important notion here. And so I have changed through my career from the JP Morgan world, which was, we've got 27 equity analysts in the US alone. We have 36 outside of the US. We have a number of people supporting them. You know, everybody's on the ground running, sort of similar things that you hear from mutual funds, right? How many people they have running around the world finding opportunities. I've abandoned that. I basically noticed in trying to be rigorous about this that the size of an investment team is completely uncorrelated with its investment performance. Now, in general, what you find is that groups that manage more money have more people. They can afford it. And whether they admit it or not, they tend to manage their business to a certain margin level as opposed to looking at what's best for investment performance. And having more people certainly is still very marketable, but it just doesn't work. So what I've tried to do is to say, look, I want to get out of the business of managing people. I want to focus on the business of managing money. And everybody in my firm does one of two things. Either they manage money or they manage clients. And that's it. All the back office stuff, we've outsourced all of that. So pretty radical model relative to the larger, more established investment management firms where 40% of the people on staff will have nothing to do with managing money or speaking to clients. They'll be in support roles. So that's what these pages are intended to show. These are the business people. Okay, performance. Boy, a year ago we were pretty smart. Now we're not so smart. And as I mentioned, this has been really a brutal year. If you take a look at 2008, here's the most important thing to glean from it. It's not that the equity market went down by 40%, which it has, right? It's not just that credit spreads have blown out as much as they have. Right? But the basic notion of 2008 is that whatever worked well historically didn't work in 2008. And so you take a look at all these different hedge fund categories, which cover all of these different disciplines, and they're all sucking wind. They're all doing horribly. Now, how is it possible that currency strategies are doing horribly, convert arb strategies are doing horribly, global macro strategies are doing poorly, equity long short strategies are doing poorly, everybody's doing poorly? I mean, it's just common sense that if you're going to manage money, you're probably going to use those things that worked in the past. And we'll talk a little bit later about why the world has unfurled the way it has. But again, the important thing is that people who use disciplines that worked in the past generally are having a very difficult time this year. Okay. So we're not alone, but it doesn't make me feel any better. This is the statement of non-correlation. So what we've done here is we've plotted monthly returns to my fund to the global macro index. We have a global macro hedge fund. There's a global macro index. So you see it there. And if you look on the right side, it's hard to read, but the R squared of this relationship is 0.33%. It's 0. So one of the things that we've done. Now, the important question is not just, that's pretty cool that you've been able to put together a global macro strategy that's done well and that's uncorrelated to other global macro strategies. The important question to ask is, how did you do that? How's that possible? Right? We know everybody speaks to each other. We know that people tend to put on similar types of trades, whether they admit it or not. How are you at 0? So that's what I'm going to touch on. Ultimately, it gets back to the investment process and having a different perspective on how to analyze the world. Okay. an important part of any investment strategy is to have diversified sources of alpha. So where are you making your money? And if you're making your money at the same time in all these things and losing your money at the same time in all these things, then what's the point of doing different things? So we invest in stocks, we invest in bonds, we invest in currencies, and we invest in some other stuff, including things like commodities. And if you take a look here, you'll see the Sharpe ratio is positive on most of these things. But the total column on the right has a Sharpe ratio that's higher than any of the others. And the reason for that is that bottom matrix, which basically shows the correlation of monthly alpha across all of these different asset classes, if you will. And they're all pretty close to zero. So with that, diversified sources of alpha is an exceptionally important part of any investment process that you endeavor to build. Okay. This, in some ways, is the most important page in the presentation.
Back to that.
Yeah.
The weights are not the same in those asset classes at any point in time, are they? You could be, the global macro product could change quite a bit from one to the next.
Absolutely. Now, we have a sophisticated optimization process that we use to figure out how to allocate to different markets. As a general rule over time, probably 40 to 45% of our risk will be in equities, probably 30 to 35 will be in currencies, and 25-ish will be in bonds. That's a general assessment. But that will change over time. There's times where most of our risk is in currencies. There's times when most of our risk is in stocks. Now, that's not because we think the stock market's going to go up. That's because the trading opportunities that we see within one asset class versus another are perceived to be greater than they are in other asset classes. And so the optimizer says, well, I've got a great idea. I'm going to go long UK stocks and short Euroland stocks. That's the best trade that I see. And so we end up with more risk in equities. Right? In this case, independent of whether the equity market's expected to go up or down. Okay. So yes, and this is on average over time. You'll see the risk here. So the annual volatility from stocks, 7.6%. Annual volatility from currency, 6%. The annual volatility from bonds, about 3%. So roughly consistent with those numbers that I gave out. And other is because it doesn't fall in either of those asset classes or any of those. Okay, this page real quickly, not real quickly, because I do want to spend some time here, and I apologize again, you can't see this, but I will take you through it. To me, the best processes are those that combine the best things about quantitative processes with the best things about discretionary processes. One has a lot of discipline, the other has a lot of flexibility. How do we put those things together? Well, it's a source of a lot of discussion. But let me take a step back and say what we do on the quantitative side. Here's what we don't do. We don't do what everybody else does. What everybody else does is they say, okay, I want to invest in the S&P 500. In order to invest in the S&P 500, I need to figure out what the expected return is to the S&P 500. So what I'm going to do is I'm going to find a bunch of factors that historically have been a good predictor of returns to the S&P 500. And from those factors, I'll build a model, and it'll give me an expected return to the S&P 500. I'm going to do the same thing for the TSX index up in Canada, for the FTSE index in the UK, for every different equity index around the world. And I'm going to have the same perspective on bonds. I'm going to figure out what are the factors that drove JGBs, Japanese government bonds, right, to allow me to come up with an expected return. And if I did that, I'd end up with an expected return for each marketplace. I'd throw it into my trusty optimizer, and it would tell me what to do. We don't do that. Now, if you take a look at what everybody else does, right, they don't have a correlation of 0. They have a correlation of 0.6 to each other because they're all a little bit different, but they all start with the same perspective on the world. And as a result, they can't get their correlation down to 0 because of their starting point. So what do? We took a big step back and we said, all right, we don't want to focus on markets directly. We're going to end up at markets, but we're going to get to markets by initially focusing on decisions. What's a decision? Intercountry equity decisions, intercountry bond decisions, currency decisions, which by their very nature are intercountry decisions. And then we also have some market timing decisions, stocks versus cash, bonds versus cash, currency decisions. Ultimately, we end up with expected returns for all of the markets that we invest in. And those expected returns are expressed as an increment over cash. And the reason why we do that is that if we have expected returns that are expressed as an excess return over cash, then it's fungible around the world. Because if I hedge out the returns, I don't change the expected return. I just add on the cash level of return. So by looking at excess returns over cash, I could throw those numbers right into my optimizer. And if I invest in futures locally, it all transpires seamlessly. So that's where we end up. But we don't get there by saying what drives the S&P 500. We get there by saying what drives the relationship between the S&P 500 and the FTSE, or the S&P 500 and the TSX. In fact, we have 13 equity markets, and so we have 12 pairwise equity trades, inter-country equity trades for the S&P 500. We have 12 pairwise inter-country equity trades for the FTSE over in the UK. For every equity market, we've got 12 inter-country equity trades that we analyze and come up with an expected return to.
So I'll make sure I got contradicted that last statement. So you're predicting the difference between the expected return on the Toronto Stock Exchange and the S&P 500.
That's correct.
As opposed to each one of those separately.
That's correct.
And so it would be fairly intuitive to me, but maybe you can just elaborate, that estimating the expected difference between those two is something that has the potential for much greater statistical power. And it's also the heart of the trade anyway, because you're going to be long one, short one. You don't care, obviously, where the TSX is, because you're going to short that versus the S&P 500 vice versa. Is that fair?
It is fair. We've expanded our universe. So when you add up, we have 6 modules, which I articulated before. If you go through the math, we have 13 equity markets, 7 bond markets, and 7 currency markets. You go through the number of permutations, and we have 147 pairwise trades. Okay? Now, they're not 147 independent pairwise trades, but they're less than perfectly correlated. And so as a result, we get far more diversification by going down this path than if we just estimated the expected returns directly on those 26 different markets. Okay? So that's issue number 1. And issue number 2 is, where are the opportunities? Do I really care as an investor if the opportunity is going long equity markets or going long UK stocks and short Euroland stocks? I'm indifferent. All I care about is, where are the opportunities? How can I make money? And that's where I want to focus my process on. So we've expanded our horizons by going down this pairwise route. And from an economic logic standpoint, let's think about an intercountry bond decision. Right? UK bonds, let's think about an intercountry equity decision. Right? UK stocks versus US stocks. Right? Now, if you take a look at the correlation to oil over time, it changes. It's very, very volatile. It goes around and around. But generally, the UK market does better than the US market when oil changes. If all I do is take a look at one market directly, do I include oil? Do I not include oil? But when I start taking a look at these pairwise returns over time, my exposure to certain systematic variables really starts to get less and less. I start to cut it in half and cut it in half and cut it in half. So that ultimately, do I have exposure to oil? I might, but my exposure to systematic variables like oil, like volatility levels, like credit levels, tends to be extremely low. And when we built this model, and we looked back over the history since inception, which goes back to 1985, what we found was that we really didn't have any correlation to any typical factor that drives a lot of other strategies. Convertible arbitrage, when does it do well and when does it do poorly? You could point to individual factors out there which will tell you whether convert arb is going to do well or going to do poorly. But with our strategy, we can't do that. I think that's a good thing, because that tells me that its correlation to the rest of the world is going to be pretty low. So that's the other thing. This diversification really, at the end, takes out a lot of systematic exposures, which is the other reason why we've done it. Yes.
Mr. Smith, I'd love a little more color on these inter-country trades. Will you talk about anything more?
Okay. It's Larry. Okay, no more Mr. Smith. And with regard to these intercountry trades, we're looking at excess returns over cash, because by doing that, the numbers are directly comparable. So we don't care what the UK equity market did. We care what the UK equity market did relative to UK cash. We care what the Japanese equity market did relative to Japanese cash. U.S. market relative to U.S. cash. Then we could transport that to any base currency. Those numbers are comparable around the world. But if you take a look at nominal numbers locally, they're not comparable, and real numbers might not be comparable either. So that's the focus of the quantitative analysis, because that's really the only way that makes sense in taking a look at cross-border trades. Yes?
The intercountry comparison, I think, was the question about one outperforming the other one. Because your fund's going to be short one country and long the other one.
Yes, and so, right. Yes, before we get to the sizing issue. So let's take a look at these. We have 13 different 13 different equity markets, and we make a series of pairwise decisions that we analyze, okay, in order to come up with expected returns. Well, long and short is an issue of the sizing of the trade. I don't want to get there yet. At this stage of the process, it's what's the expected return of going long UK stocks and short US stocks. Right? That's where we are at this point in the process. So that's what I'm trying to estimate. From that, I'll end up down there, but I'm not there yet. And I could come up with a pairwise trade which says UK stocks are more attractive than US stocks. But by the time I get to the sizing of trades, I could be flipped in the other direction, because remember, that's only one perspective on each of those equity markets. And I've got 12 intercountry perspectives on each equity market, one stock bond perspective locally, and one stock cash perspective locally. So there's a lot of perspectives on each market, which ultimately get synthesized together through the miracle of matrix algebra to come up with what the final expected return will be on each individual market. But I get there through this intermediate step, and I do that because I can identify signals that are much more reliable. You know, oil comes and goes as a driver of interest rates, for example. But at the end of the day, we've been able to find signals which really have stood the test of time. So better signals, more diversification, greener pastures, because I've opened up my, my horizons here. All of those things are put in, and the reason why we've adopted the architecture that we have. I'm sorry, there was another question in the middle.
What type of leverage do you need to employ to exploit that type of pricing?
Leverage is an exceptionally important question to ask. It's probably the one thing in our product that our answer doesn't get a resounding standing applause from our clients. And here's why. If you think about most strategies and you say, all right, I'm going to be an equity long short guy, right? How much leverage do you employ? The correlation with leverage employed and the amount of risk that you're taking and the amount of downside that you're exposed to is going to be pretty high. Leverage is a reasonable first order proxy for the amount of downside that you could have. Right? Now let's take a look at what we do. About 2/3 of our risk gets allocated to these intercountry trades, stocks, bonds, and currencies, as opposed to market timing trades, going long or short stocks, long or short bonds. Right? Now, if you take a look back through time, well, we went back to 1985. We took a look at the returns to this model. And one of the curious things was that when all hell was breaking loose, the model did pretty well. It didn't always do spectacularly well, but it never had the type of spectacular downside that a lot of other strategies did. And it got me to really query why is that the case? And ultimately, it gets back to the following phenomenon. As a general rule, the statement that I'm going to make, other people will make the same statement. You need to understand that you can't say anything definitively. But as a general rule, when the stuff hits the fan, the correlation of risky assets goes to 1. So if you have, let's say you want to go long equities. You say, all right, I want a beta of 1.5. Right? Okay. How am I going to get to that beta? Well, I want to diversify my equity exposure. So instead of just putting it in U.S. equities, I'm going to put some in U.S. equities and UK equities and Japanese equities, et cetera, around the world. When you do that, your ex-ante risk will go down because there's diversification to doing that. Historically, the correlation of those things is on the order of 0.7 over a long time period. Right? Now, all of a sudden, we go through that worst-case scenario. Now, what happens in that worst-case scenario? Right? Equities go down. Right? Volatility spikes up. So, you end up losing a lot more in each market than you expected. And correlation goes to 1. So there's no diversification. So, you end up with 2, 3, 4 times the risk that you had expected up front. if you focus on inter-country decisions, equity or bond decisions, and this isn't third wave global, this is a statement about people who focus on inter-country decisions, they tend not to be exposed in the same way, because if volatility spikes up, the risk of each pairwise trade will go up with volatility, right? Because of volatility rising. On the other hand, when volatility rises, the correlation spikes up. Now all of a sudden, what's happening? The short side of my book is tracking the long side of my book more precisely. I've got a better hedge. I've gone from two markets that I went long and short, long one and short the other, because I thought it was a reasonable hedge at a correlation of 0.65. Now all of a sudden it's a correlation of 0.95. So there's offsetting factors that lead to the risk going down. So what does that mean? What that means is if you take a look at the leverage in our fund, probably doesn't give you the answer that you want in terms of how much downside there is, made further complex by the fact that we invest across equity, bond, and currency asset classes. Now, why is that important? Well, let's just think about it. If I put, let's say I had 100% leverage, I was 100% invested, and I did that by putting all my money in equities, right, and diversified across all these different markets, but they were all long. So, and let's say that gave me a expected standard deviation of 15%. Right? We know from what we just talked about, the downside's pretty significant. Right? Let's say I got to a 15% risk by having a portfolio of stocks and bonds. Right? Well, I could have 200% leverage, 300% leverage, but my downside's going to be a lot less. Because if stocks are doing pretty badly, chances are bonds are going to be doing pretty well, because there's a negative correlation of stocks to bonds. Similarly with currencies, the carry trade, going long high-yielding currencies and short low-yielding currencies, tends to be very highly correlated with equities. So I'm long equities, I'm short the carry trade. Looks like I have a lot of leverage, but I've got a pretty good hedge built in. So we're pretty complex with regard to leverage. All right, now that I skirted the question, as a general rule, we have about 350% leverage in our normal share class, and we have a double leverage share class. It's about, it's twice that, 700%. But again, the important thing is how much risk there is. And when we've taken a look through time, our forecast of risk generally has been pretty close to what the risk has turned out to be. So we feel pretty good about looking at the ex-ante standard deviation number and not relying on other proxies such as leverage. Is that a question coming in? I'm sorry. Yes?
Okay, so I read in an interview with you that you said that with the carry trade, you had to be very precise to know when it's going to reverse. And you said that you had some signals that would tell you when it would reverse. Can you talk about some of those?
Boy, you're getting right at the good stuff. Okay. This is getting into a signal. Right? But step back. I've got 6 different modules. Right? 3 are intercountry stocks, intercountry bonds, and currencies. 3 are market timing. Right? Stocks versus bonds, stocks versus cash, bonds versus cash. Right? For each of those 6, I have different signals. Right? I'm not going to use the same signals. Right? There's different drivers of the pairwise returns within each of the decisions within a module. So I have different signals for all those different modules. In the currency module, I've got 5 different signals. Now, the most common signal that most people use in currencies is carry. People have noticed that the difference in nominal interest rates tends to lead to excess returns. Should it? No. In theory, it shouldn't work. In practice, it does work. Sort of stuck. So, we could all dream up theories as to the reason why it works. But at the end of the day, there's an awful lot of money out there that for years was going long the Australian dollar and short the Japanese yen and making money with it. Right? All of a sudden, the last year, that trade has been one of the most punishing trades you could be in. People have lost an extraordinary amount of money. Now, why has that happened? Well, generally, what we say is as follows. People's risk aversion, the market's risk aversion, will drive whether those types of systematic trades, and the carry trade really is a trade that's analogous to equity beta. So people's level of risk aversion is going to drive whether that systematic variable will end up being positive or negative in terms of its impact on the markets. So if people reduce their risk aversion, and they want to get more and more money invested, right? Stocks are going to go up. Right? The carry trade is going to do very well too. They will tend to be pretty positively correlated. Right? When people's risk aversion rises, the opposite happens. Right? Equities go down. The carry trade does very poorly. The yen outperforms the Australian dollar in the current situation. So the challenge is, how do we figure out where risk aversion is going? Now, an enormous amount of research that we've done. And what we found is that most things that you look at aren't particularly helpful. For example, the VIX, equity volatility, implied equity volatility, is a great coincident indicator. It does a good job of telling you what's already happened. But the VIX goes from 20 to 30, the carry trade's already gone down, it's too late. So what you really need as investors is to get an advance notice on what are the things that will cause risk aversion to rise over time, which will cause the carry trade to work in reverse. So the things that we found are most helpful on that front are credit spreads. Credit spreads tend to have more serial correlation. When they start widening, they tend to continue to widen. And as a result, we found credit spreads to be the best leading indicator. And we've got this proprietary combination of different credit spreads. We do this on equities also in terms of intercountry equity decisions that are based on valuation. We find also that when credit spreads are widening, people don't look at valuation anymore. When credit spreads are narrowing, people love valuation. Now, ultimately, a trade works because people in the market believe it. They may not believe it today, but they have to believe it at some point, otherwise it's not going to work. So why do valuation trades work? Because at the end of the day, you have a bunch of people looking at stocks saying these two stocks have the same earnings growth, but one has a multiple of 10, the other has a multiple of 13. Might as well buy the one that's a 10. Similar thing happens with markets, with equity markets. Right? You can look at multiples of markets and come up with a similar conclusion. Right? So when are people going to be able to pursue those trades such that those trades work? When they have money. When do they have money? When credit spreads are low and when leverage is available. When credit spreads go up, all the brokers say, we're not lending out any money anymore. Prime brokers pull in leverage. Banks, tighten in their reins also. And all of a sudden, all these people that were just going along the carry trade because it was a gift, it was a no-brainer, all of a sudden they're getting calls, you got to take that money off the table. The carry trade starts working in reverse. And things get worse, they have to take more off the table. So the capital flows, which cause the carry trade and currencies to work, tend to be, changes in them tend to be preceded by changes in credit spreads. And it's not the level of credit spreads, it's the change in the level of credit spreads. Everything in investments is about a change on the margin, not the level. And so that's what we do. We take a look at a combination of international and domestic credit spreads. We take a look at that in a sort of clever way relative to history. And to the extent that credit spreads are widening, we're going to lower our exposure to the carry trade. And if they widen a lot, we're going to reverse it. And that's been our single best performing signal since inception of the fund 4 years ago. Boy, nothing's sacred anymore. I'm glad you asked that question as opposed to some other things that I've done in my past. Yes?
What's your process of taking those signals and plugging them into the optimizer, changing the variables?
Okay. Mentioned before that I'm a reformed quant. I'm not a big fan of mean variance optimizations. And I'm not a big fan of them because garbage in, garbage out. Here's the most important realization that at least I've come to is as follows. The way people build quant models is over here, they build expected return modules. They have all these different models and they say, okay, these factors forecast the expected return for this market, and they get all these expected returns. Right? Over here, they build a covariance matrix. Right? These things generally have nothing to do with each other. Right? And guess what happens when you put them together? Right? All you need to do is to find two markets that are highly correlated and have a small difference in expected return. And the optimizer does this. It wants to go long a gazillion percent of one and short a gazillion percent of the other. And you look at it and you say, this doesn't make any sense. Right? So there's a better answer, which is black Letterman. I don't know if you guys have gone through black Letterman at all. No. Okay. There's a type of optimization algorithm named black Letterman, which was done by Fisher Black and Bob Letterman. Fisher Black, I will tell you, I had the privilege of meeting on several occasions. He was the single most intelligent person I've ever met in my life. And please don't mention that to Bar Rosenberg because I was one of his disciples when I was out at Berkeley in graduate school. And he doesn't like to hear that anybody else is smarter than him. But Fisher Black was scary smart. It didn't matter what the issue was. He'd sit and listen, and whoa, just incredible. So Fisher left MIT, and he went to Goldman Sachs, who was becoming the preeminent brokerage firm at the time. But the smart people knew that they were the best, but they weren't, they were amongst the best at the time, is what the general perception was. And Goldman Sachs had this very strange idea, which was, hey, we've got all these good ideas that we give to clients so that they'll trade with us. Why don't we use them ourselves? Why don't we invest our proprietary capital to benefit from those ideas? Right? Now, everybody does that in the world now, but when Fisher Black got to Goldman, this was sort of a new idea. So Fisher went to Goldman with all these ideas on how to incorporate people's thoughts about the markets and create thoughts about the markets and come up with position sizes that made sense and made money for Goldman Sachs. So Fisher did this for a while. And then he said, I'd really like to meet some of your clients. Now, in the early 90s, the area that had far and away the most quantitative work done to it was bond land, not equity land. Equity land, the general perception was, yeah, well, we use that quant stuff for risk management. We get these borrower risk estimation numbers and factor exposures and all that, and I look at them, but ultimately I pick stocks. Right? Let's face facts, right? That's how I manage money. Whereas in the bond world, there really was a much tighter integration between quantitative notions and disciplines and the way in which portfolios actually got managed. Right? So Fisher said, I want to meet your biggest bond clients. Now, two biggest bond clients at Goldman Sachs at the time were the two biggest active bond managers in the world. It was JP Morgan and it was PIMCO. PIMCO was in Los Angeles, JP Morgan was in New York. So a couple of us went down from JP Morgan to meet Fisher and spend some time with him. And I got to understand a lot of the things that he did. Well, here's one of the many things that Fisher did. He's a great guy to read up on. So a guy from General Motors, whose name was Ed Sullivan, not the entertainer, different Ed Sullivan. This guy wasn't nearly as entertaining. Ed had a problem, which was the problem that everybody had with mean variance optimizations. He had his model that came up with expected returns over here. In this case, he was head of asset allocation for General Motors pension plan. So his job was to tell Gordon Binns, his boss, whether they should put more money in EFA or more money in emerging markets or more money in bonds. So he had expected returns that he generated over here. He had a covariance matrix that he generated over here, squashed them together in a mean variance optimization, and he said, garbage. Now, what pension plans did when they got garbage is they said, well, it can't be a problem with the tool. We know the tool's right because the theory says the tool's right. And so therefore, what we need to do is just make it a little bit more pragmatic. How do we make it pragmatic? Well, that's pretty easy. Why don't we put these things called constraints on there? So in General Motors' case, let's say that their target large cap equity weight was 35%. We're not going to allow it to go up to 40% or below 30%. Right? Now, the optimizer wanted to go to 110% because it had a 0.5% higher expected return than small cap stocks, which were correlated at 0.92 to it and had a higher risk. The optimizer said, oh, this is easy. We can make a lot of money on this trade. Right? So what ends up happening is that you set these constraints for all the things that you're going to invest in, and the optimizer is so noisy that you just go to the constraints. And then the next month you switch constraints. And then you keep switching constraints. Right? Doesn't really make any sense. So Fisher got called in by one of the partners at Goldman. And the partner said, we have one of our most important clients has this problem. Laid out the problem. And Fisher's immediate response was, well, he shouldn't be doing that. And the guy from Goldman said, it's very nice. We don't tell our clients they shouldn't be doing what they're doing. What we do is we help our clients do what they're doing better. So Fisher said, okay, now I'm starting to understand the business side of the investment management business and the brokerage business. Turns out that about 8 or 10 years prior to that, Fisher had worked with Jack Traynor on a problem that was pretty simple. They had a bunch of equity analysts who were picking stocks. They had a quant model for picking stocks. And he said, how do I combine the two? Well, that got Fisher thinking down a certain path. Right? Now all of a sudden came to asset allocation land, and Fisher leveraged from that work, and he brought in a guy named Bob Letterman, who's still at Goldman Sachs, another very bright person, a really first-rate guy. And here's what they did. They said, the expected returns that you got over here, they can't be done over here when the covariance matrix is over here. We have to do these things simultaneously. How do we do it simultaneously? Right? I certainly had no idea. But those guys were pretty bright people quantitatively. And they figured out how to do it. And in effect, what Black-Letterman is a two-part optimization. The first part says, let's start with expected returns that we're going to put into the process. Let's mash in the covariance matrix. And what the covariance matrix is going to do is to change the expected returns so that they make more sense. So for example, if we have two highly correlated markets, equity markets for sake of example, one has an expected return of 10% and the other has an expected return of 0%. Well, if they're highly correlated, what's the chance that their expected return could be 10% off? Their matrix algebra approach squashed together the difference of expected returns amongst highly correlated assets and maintained the difference in expected returns of uncorrelated assets. And all of a sudden, once they did that, then all of a sudden they fed these revised expected returns into a mean variance optimization. And now you could look at the results of that optimization and say, this passes muster. This makes sense. Right? Now Ed Sullivan looked at it and said, yeah, I should be 3% overweighted large cap equities, not 103%. So Black-Letterman is just an enhancement on a theme. It's important because most straightforward uses of mean variance optimizations can fall short. I hope I didn't step on anybody's toes here.
No, I mean, you didn't. I mean, we do this in one of the classes. People have this process, right? And so they're, and they come with these corner solutions and these asset allocations. It's pretty easy to see when you look at the assumptions that they've made that they cannot, they will lead to a corner solution. Especially if you rely on historical data. I mean, obviously, IFA outperformed S&P 500 every year by 10%. You plug that in, duh, you're gonna get this corner solution portfolio. But what you're saying is that Black-Letterman is a very intuitive understanding is that it's forcing you mathematically to avoid obvious mistakes.
That's right.
Which would be highly correlated asset classes must have similar expected return. They must have similar covariance, things like that. It's just a way to, rather than just messing with the assumptions until you get a coherent solution. The discipline approach.
That's exactly right. So what it's saying is that let's apply standards of reasonableness. So let's think about Black-Letterman for a second because it's important in how to think about markets. Right? Let's say I look up and I say, I think U.S. bonds are going to do very well here. The economy has been exceptionally weak. Bonds have not done as well as one would have thought given what's happened to the stock market, mainly because of concerns about a lot of supply coming out of all the fiscal stimulus that's happening. But ultimately, bond yields are coming down in the U.S. Right? So I want to go long bonds. Right? Now, in a traditional mean variance approach, you would just say, okay, I think the expected return to U.S. bonds is 5% over cash, making up a number. Right? Pretty attractive level. Right? Black-Letterman looks up and says, well, if you think the expected return to U.S. bonds is quite positive, right, you have to think the expected return to Canadian bonds is quite positive because the correlation there is 0.82. And you have to think that the expected return to UK bonds is quite positive and European bonds. Right? And it probably means less for Japanese bonds because it's lower correlated. So Black-Letterman takes care of all of those things that as investors we tend to overlook. The implication of one forecast spans many assets because they're all correlated, either positively or negatively. Right? If you like equities, you probably like the carry trade in currency. So if you're increasing the expected return in your optimization to equities, you probably should increase the expected return in your optimization to the carry trade. Otherwise, what's that mean variance optimization going to do? Way long equities, way short the carry trade because they're such a good hedge against each other. So Black-Letterman, again, applies standards of reasonableness. And there's one other part of it, which is something I've always felt was important, and I never had the horsepower to figure out the answer, but is involved in Black-Letterman, which is there's levels of confidence about each forecast. So, for example, intuitively, if you're a portfolio manager, you have two people come over with the same idea. One guy comes over and says, you know, I think bonds they're not going to do very well here because there's all this supply, and I'm worried about that forecast because of the economy. Somebody else comes over and gives you a whole different perspective and says, I have every confidence that bonds are going to do really well. Well, intuitively, you're going to give more weight to the second forecast than you are to the first forecast. As a structural part of Black-Letterman, you put in the standard error of your forecast, which is pretty straightforward in a quant world. It's a little bit dicier when you put in discretionary decisions, but still possible. And by putting in the standard error of that forecast, it gives Black Letterman a way of weighting all of these different decisions. So let's say the pairwise expected return for the S&P 500 versus FTSE is 5%, and there's a high level of confidence in it. The expected return for the S&P 500 versus the TOPIX in Japan is minus 5%, but there's a low level of confidence in it. Right? You may have gotten minus 5%, but the historical tracking error of that bet was very large. So you got a low R squared, high standard error. Well, what Black Letterman's going to say is put more weight on that first one than the second one, and it's going to end up being positive about the S&P 500, even though one pairwise return was plus 5, the other one was minus 5. A lot to speak about Black Letterman, but it's important because, I was telling Dave about this before, when I was at Credit Suisse, we had a lot of really smart people around the world, and I would travel around the world and meet with people in all our different offices, and that's everywhere from Sydney to Tokyo to all of Europe, obviously Zurich, London, Frankfurt, Paris, the U.S., Brazil. I'd go to all these different places, and I would sit down with the investors in each place, and I'd say, all right, tell me what's going on. The stock guy would tell me about some stocks. Another type of stock guy may tell me about certain sectors. A bond guy be telling me about credits. A global bond guy be telling me about countries and their economies. Everybody would wax poetic about all of these different ideas that they had. And they're all very good at trying to figure out where the opportunities were to make money. And somewhere along the way, I would say, stop. How much do you put in it? And inevitably, and this wasn't just a Credit Suisse problem. This was my biggest issue over 4 years and probably the area where we made the greatest advances. This is everywhere in the investment management industry. And while it's gotten better, it's still a major problem. Inevitably, when I would say to that person, how much do you put in it? The level of sophistication would just fall off a cliff. The guy who was able to recite half of the balance sheet by memory all of a sudden would say things to me like, well, I usually equal weight all my small cap holdings. I said, well, why would you do that? So you put as much money into a tech stock as you would into a utility, even though it's 3 times the volatility? And what if you have 8 tech stocks and only one consumer staple? Doesn't that matter? Consumer staple is going to be a diversifier. Your 8th tech stock is just going to amplify the risk that you have to that sector, right? So this Black Letterman stuff is important in translating ideas about markets into position sizes. Not only directionally, but also the magnitude of the position size. Very important part of the whole game. Okay. Now, ultimately, you'll see, or you won't see, because it's hard to see here, but on the right side, it says discretionary process. So we have a completely independent process where I've got a couple people who are looking at the world's economies and trying to figure out where are their opportunities. What's going on in England? What's going on in Euroland? How bad is the economies there? What's likely to happen with the central banks and the like? And we come up with trade ideas. Now, ultimately, I need to meld together these discretionary ideas with these quantitative ideas. Right? And to do that, ultimately, what we decided to do, which we didn't do our first 2 years, but the last 2 years we've been doing it, is to use Black Letterman. Because Black Letterman says, give me a view about a market, give me a covariance matrix, and I'll churn out what the expected return is. So we have 147 pairwise views. Each one's exactly an expected return of a pairwise trade. Each one has a risk associated with it, and each one has a standard error associated with it, which is the level of confidence. And then we have some discretionary views. Sometimes I have no discretionary views. I'm happy to use the model. Sometimes I have a bunch of discretionary views. Factor those things in. And what Black Letterman does is give me a seamless way of integrating those two things together. Yes?
On the discretionary process, well, if I think of a lot of people that are quantitative, then these models are models, and so they are relationships with historical data, and then maybe weighting historical data very differently. It doesn't have to be a fixed window of time. So would it be fair to say that most of your discretionary trades are something where you think that the regime has changed, and therefore the model is no longer fitting the data, or is it a situation where there's another factor that just wasn't in play before? I'm not sure that the elections are exactly different. Both can you apply on that with?
Yes and yes. So in effect, if you think about a quantitative model, it brings you a lot of good stuff, but it's very rigid. We use these factors in this way all the time. Not allowed to change it. Those are the rules. That's what the quantitative model is. It's got a bunch of rules. These are the rules all the time. Now, the quantitative model only knows about these factors. It doesn't know about things that are going to affect the market that, probably can't fit into a quantitative model historically. Take a look at oil. Let's go back to oil. Oil vis-a-vis interest rates. If you looked in the 1970s, oil going up meant that interest rates went up because oil going up was inflationary, brought interest rates up. In the 1980s, there was roughly no correlation between oil and interest rates. In the 1990s, there was a negative correlation. Oil went up, interest rates came down. Why was that? Because the belief was that monetary policy was successful enough, cognizant of the problems enough, action-oriented enough, so that if there were inflationary increases from oil, they would tighten policy so that the overall inflation rate in the economy wouldn't go up, which by definition meant they were squashing growth. So now all of a sudden we went from the 1970s where oil going up meant that interest rates rose to the 1990s where oil going up meant that interest rates came down. How do I put that in a quantitative model? It's pretty confused, isn't it? So there are things that change over time, and it's very hard to fit things that change over time into a quantitative model that's relying on a longer time period to establish relationships. All right? So one example of what's going on. So when I was very negative about oil, at $130 on oil, I started jumping up and down and started saying that oil was coming way down. I was on TV a few times. I've been on CNBC and Bloomberg quite a bit, talked about oil coming down. At the time, right, conventional wisdom was pretty straightforward. Well, wait a second. China is going to grow at 12% forever. India is going to grow at 8 to 10% forever. These guys are industrializing. How can oil come down? So I would apply what I like to call the common sense metric, which, not everybody agrees with me as to what's common sense, so it's probably just what's appealing to me. But what I would say to people is, okay, there's been a 1% supply-demand imbalance in oil over the last 3 years. How does a 1% supply-demand imbalance end up with oil tripling in price? Now, I could understand going up by 30%, 20%. Right? Triple? It's up 200%? And if you take a look at the futures contracts, actually it's very funny, the airlines started sending out all of these blast emails, which talked about the fact that, I'll get the number wrong, but it's approximately right, 66% of the people who held oil futures had nothing to do with the oil business. Right? So the things that drove oil historically, which were the trade of oil, ceased to be the things that were driving oil currently, or at least were no longer just the only thing that drove oil currently. You had a bunch of people, hedge funds, who were buying oil because oil was going up. You had a bunch of people who were hedging on the other side prematurely, saying, I got to buy oil in the future, I might as well buy it now. So there was an enormous amount of incremental demand for oil, which caused that type of exponential pattern that we saw. Right? Oil's, what, $58, $57 right now, down from a peak of 147. So if you have that type of insight, what does it mean for the markets? Well, what it probably means for the markets is I don't want to be long Canadian equities, and I don't mind being long U.S. equities. And so those types of insights found their way into the portfolio by looking at a factor that we couldn't really fit into the model. Here's another example of factors that can't fit into the model. Macroeconomic variables. Now, that may seem strange. I said before that all of our signals pass muster in terms of having economic relationships as their bedrock. And now I'm coming in saying macroeconomic statistics can't fit into a model. Any ideas why I would say something that outrageous? Because there's a lot of models that use a lot of macroeconomic statistics. 1998, I was pounding the table while at JP Morgan. What I was saying was that equities were grossly overvalued, and I was saying that the consumer was spent. And the reason why the consumer was spent was because the savings rate was minus 2%. Long-term average savings rate 6% for a U.S. consumer. It had gone down to minus 2. I mean, this was so obvious. Right? I was wrong for a year and a half, and then I looked smart again. That waxes and wanes. Right now we're in the stupid phase. what was going on there was that the economic statistic as it released was flawed. Now, the savings rate's a great example because the way they get the savings rate is the remainder of two other variables that they forecast. And since the savings rate's 6%, now down to minus 2%, small errors in the estimation of those other two variables get amplified in a pretty big way in the remainder, the residual of this equation. Okay? And in 2003, all of a sudden, benchmark revisions were issued. For those people who aren't familiar with benchmark revisions, if you want to use economic data, make sure you understand what benchmark revisions are. So when they go back and they change all the numbers historically, and all of a sudden in 2003 they told me that the savings rate in 1998 was 2.2%. It wasn't minus 2. Sorry, we were wrong. So you can't really use that type of data. First of all, the historical data series that you're looking at is not the data as it was announced. It was the data as it was restated. So you're comparing apples and oranges to start with. You have issues of the periodicity, the frequency of the data. You know, we used to use a variable called GDP revisions. You know, was GDP being revised up or being revised down, because that tended to have some serial correlation and told you about future GDP numbers. We used to use that as a signal for currency. You know, faster growing economies tend to have stronger currencies, and vice versa. We found that that really stopped working, but the bigger issue there was that was quarterly data. I'm managing money every day. Quarterly data really doesn't help me a whole lot. So most of the data that we use is market data. This is not to say that I don't want to take a look at the unemployment claims or any other economic data series. But I've got an economist in-house. He digests it. He tells me the data is good, the data is bad. And from that, we will create views about the world that will infuse into the overall portfolio. But they're arrived at looking at completely different data sources. Regime changes are hard. So I'd love to tell you that there's a regime change. Maybe the commodities going the other way was a regime change. That would be a good example of that. But you know, it's hard to take a look at regime changes. We always know about them after the fact. Okay. These are the markets that we actually invest in. Again, 13 equity markets, 7 bond markets, and 7 currencies. Everything here is invested in with futures. The nice thing about futures is there are a lot of nice things about futures. One thing is I don't have to worry about currency risk. Because if you think about what a future is, a futures contract is long the underlying asset and short cash. So not only does it capture the excess return over cash, which again is what our expected returns were, if you remember from earlier comments, but also there's no currency exposure to a futures contract. The P&L is independent of any currency. So that's why we like to use those. That's right. You're long and short two things in the same currency, so you offset the currency risk. I have 7 currencies, but I only invest in 6 currency futures. And that's simply because currencies are all pairwise trades. No such thing as investing in the yen, but I can invest in the yen-dollar rate. So we invest in 6 different US dollar-based futures contracts to cover the other currencies that are up there. We analyze all the 21 different cross trades, but ultimately we invest in those 6 different markets directly. Okay, I mentioned what the process was. This just goes through that. This tells you what the signals are. And question much earlier, if you take a look at the bottom left, you'll see, well, I'll tell you what you could see. It says there's modules here, and each row under module are those 6 different modules. So 3 of them are local, bond cash, stock bond, and stock cash. I only look at those locally. One of my pet peeves is you'll never hear me say things like global stocks versus global bonds. The indexes have different country weights. If you have different country weights, you mix in apples and oranges. I want to take a look at one set of markets that has one set of macroeconomic issues, one set of central bank policy issues. I don't want to mix and match all the different things around the world. So the first 3 are the local decisions. Those are the market timing decisions. And the next 3 we call global, but those are the intercountry decisions. And then for each, I've got a signal, or a series of signals, that span different categories. The reason for having them span different categories is basically to get undiversified sources of alpha in there. So instead of saying, all right, the way I analyze stocks is I take a look at 5 different valuation statistics. Well, guess what? Those 5 different valuation statistics aren't much better than one. And arguably, they're worse than one. maybe a little less risky, but a lot noisier. Pick the one that makes the most sense, focus on that, and then find other signals which are uncorrelated with it. So the first column says fundamental, it's basically valuation tools. Second column says market, it's basically technical tools. Correlation of the first two columns is 0. Correlation of the first two columns to the third column, which are signals which tell me about the macro environment, is 0. By good fortune.
By good fortune, okay. 'Cause I was confused
So,
on that all along.
right. So I was looking for that, but when I said, okay, what's going to give me a good sense as to whether the economy is going to be accelerating or decelerating? Because if it's accelerating, I don't want to buy bonds. I want to be short bonds. And if it's decelerating, I want to buy bonds. Turns out the best leading indicator we could find with market data is a change in the shape of the yield curve. Change in the shape of the yield curve is fairly uncorrelated with the level of real yield. Okay. And then the last column is an interesting column, which it's really unique to us. I call it our interaction column. And this is a great example of how models get built over time. You look at one thing and you find something else. We see this with medicines all the time, but it's true with quantitative models in finance also. So I was a bond guy, and if I drink enough, I'll admit that I'm still a bond guy. And bond guys know one thing. What they know is that the world begins and ends with interest rates. And if you know where interest rates are going, the rest is easy. Those equity guys, they're just a bunch of storytellers. Okay? If you know where interest rates are going, you've got every answer in the world. So I set about the path proving that. And I said, okay, we're going to prove that based on where interest rates have gone, we know where equities are going. Guess what? It doesn't work. It doesn't work at all. The reason why it doesn't work is that interest rates can rise because the economy's strong, good for stocks, or because inflation's bad for stocks. So as a result, I said, all right, let's step back here. But as long as we opened up this avenue of research, let's take a look and say, well, what about going the other way? And if you take a look at the stock market turns out to be a good leading indicator for a number of things. A lot of people say the stock market's amongst the best leading indicators for the economy. I'm going to change that statement. The stock market is a causal factor of the economy. What happens when the stock market goes up? Consumers are feeling pretty good about themselves and about their future. They tend to spend more money, good for the economy. And when the stock market goes up, the cost of capital goes way, way down. Corporations will tend to expand. Capital expenditures will tend to go up. Both those things are good for the economy. So when the stock market goes up, the economy tends to get stronger. That raises interest rates. Higher stock market means bad bonds going forward. Right? Stock market crashes down 40%. Pretty bad for the economy. Right? Pretty bad for consumer spending. Pretty bad for capital expenditures. Right? And as a result, interest rates are likely to come down also. Now, the reason why we put in risk preferences is that there's actually a second reason why that works, which is that investors, by and large, use the proverbial rearview mirror. Now, what do I mean by that? All I mean is that, well, I'm the youngest of three, the only one who went into this crazy business. My oldest brother is just exceptionally smart and works for a company outside of Boston that does most of the work for the Air Force, a lot of Star Wars type stuff. And periodically he'll call me up and he'll say, okay, I need to figure out what to do in my 401k. It says here that stocks are returning 13%. And I would say, whoa, what do you mean are returning? And he says, well, that's what it says right here. And I'll say, Barry, no. What it says there is that stocks have returned 13%. Not are returning, have returned 13%. And he says, what's the difference? Right? He's a really smart guy. So in general, what happens is that when people open up their statements, and the statement says stocks are down 40% this year, right? All of a sudden they become more risk averse. They sell stocks and they buy bonds. Another reason why the stock market is a leading indicator for bonds. And of course the opposite's true also, as we saw in the 1990s. So that's what risk preferences mean. Now, the same thing applied to currencies, relative stock market movements. One stock market's up 30%, the other's down 20%. What tends to happen is that the roaring stock market is a magnet for capital. It's what we call investor preferences down here. So if you take a look at currency decisions, differential returns to stock markets tend to be a reasonable indicator as to where capital flows will be going, which tends to give you a reasonable indication as to which currency is likely to do better or worse. So all of these signals, there's only 18 signals, an average of 3 for each of these modules. You don't need a lot of signals. But what you need are signals that stand the test of time and signals that are uncorrelated to each other. And if you have those things, that's all you need. Every once in a while, people would come in and say, I've got a great model. It forecasts the S&P 500 with 180 different variables. And I would say, thank you very much. It's nice knowing you, but we really don't have anything to talk about. Because if you have that many different variables, it's just a statistical exercise. It's not an economic exercise. Okay. Yes?
So you say you actually can execute a lot of the trades in futures?
Almost all of them.
All, right. So have you had any problems with counterparty defaults this year?
Well, it's one of the great things about futures. Right? There are no counterparties. Futures have a clearinghouse. And so as long as the futures clearinghouse is solvent, and all of them are, we don't have any issues. As opposed to, and even for currencies, when we first started out, everybody said, how are you going to invest in currency futures? Everybody uses currency forwards. Right? And the reality is, yeah, a currency forward market is way bigger than the currency futures market. But if you do a currency forward, you have counterparty exposure until that forward contract expires. Right? The reason why I don't like forwards is that there's a price to go back to that broker and say, I want to close out that position. If the broker knows you want to close out that position, it's going to cost you an extra tick. And most people are willing to pay it because they don't want two offsetting positions with two different brokers. So that's one of the reasons why we use futures, is we don't have that issue at all.
But what about those that have the clearinghouse reverse terms?
Well, no, these are clearinghouses like the Chicago Board of Trade.
Okay.
Right? The Chicago Options Exchange, NYMEX, things like that. So that's all they are, as opposed to a brokerage company or the like. Yes?
Were your strategies affected by the short sale ban?
Sorry, was my strategy? No, it wasn't, because the short sell ban was on individual equities, and we're investing in broader markets. So at least directly, we were not affected. One thing I was happy not to have to deal with. Now, one thing I haven't talked about is how much weight do you put on each of those signals? So another question here is, I've got 5 different signals for currency. 2 under valuation, 1 under market, 1 under macro, and 1 under interaction. How much weight should I put on each of those signals? Now, one reasonable default is to equal weight all of them. Right? Well, what we did is we took a look back through time. And what we looked at was whether there was momentum in how well a signal did. Not whether there was momentum in the markets, but momentum with regard to signal performance. So if you were to map signal performance over time, the question there would be, did it have positive serial correlation?
So when the signal works good for a while, does it continue to work for a while?
Exactly. So signal's positive for a while. What does that tell you about whether it's likely to continue to work well or just the opposite? And we found that there was some positive momentum. So we put in place a so-called Bayesian process to estimate those signal weights. And what this chart shows is that this Bayesian process basically made a good model better. It's not the reason to use the model, but it increased the historical Sharpe ratio by about 1/4 of a point. That's only one reason, though, why we use this Bayesian process. The second reason is that with only 18 signals, I'm going to argue that fewer signals is better. It leads to a more robust model, lower chance of data mining. But at the same time, I'll also recognize that fewer signals mean that 1 or 2 signals can really hurt me pretty badly. So how do we keep the 1 or 2 rogue signals from taking me down? Well, what we do here, what this Bayesian process does is when a signal's doing well, keeps on increasing the weight that we give to that signal, because signal doing well means it's going to continue to do well. When a signal's doing poorly, we keep on lowering the weight that we give to that signal, because signal doing poorly means that it's likely to continue to do poorly. So the signals that would really bring a strategy down over time get such a low weight that while they'll hurt us, they don't kill us. So there's a risk management element in using this so-called Bayesian process to come up with signal weights. And finally, backtesting. Now, nobody's ever seen a model whose backtest didn't look very good. So we know that there's problems with backtesting. Right? One of the ways around that, to me, was this Bayesian process. And here's what I mean by that. In January of 1990, our data goes back to January of '85. So in January of 1990, I know what the signals are. I need to know what the weights are that I'm going to give to each of those signals. How do I do that? Well, this Bayesian process uses all of the data prior to January of 1990. So in effect, this Bayesian process was estimated out of sample, not in sample, which increases its robustness, which makes me feel better in using it.
So it's coming forward with an implementable strategy, not a back-tested model.
Yeah, it's not dependent on estimating things that you wouldn't have known at that time. That's correct. So that's the Bayesian process. Discretionary process. Talk about this in a little bit. Risk management, super important. There's nobody who manages money anymore without pretty rigorous risk management discipline. So what do? We start off with exposure limits. These exposure limits will limit the amount of leverage that ultimately we can have. But we never reach any of these. See, this last column says net asset class. We've never been close to any of those numbers. We have been close to some individual markets that are first column of numbers. But overall, our leverage is a small fraction of what this would allow it to be. Liquidity. Second bullet says positions targeted not to exceed 50% of average daily volume. Trades targeted not to exceed 10% of average daily volume. We don't want to be pushing the markets around to the point where we're hurting ourselves. So we put these arbitrary limitations in place. We use options selectively. So for example, if I go back to 2 winters ago, the big issue back then was the carry trade. And all the media wanted to talk to me about was, the carry trade. There's, $800 trillion that's invested in the carry trade. I have no idea where these people get these numbers, but they would always throw out some absurd number and say, what's the chance that all reverses and we get a radical move? And it's a typical media question. But we were really short the yen at the time for a variety of reasons. And to me, it signaled that there was some risk to that position. So instead of taking the position off, what I did is I bought some out of the money yen calls. And as it worked out, the yen did snap rally, and this saved me a bunch of money. So we'll do this selectively, not always as well as the example that I gave. Talked about the Bayesian process, scenario testing we take a look at too. Forecasting risk. So let me tell you what you're looking at here. Every day when I look at the portfolio, my covariance matrix gives me an ex-ante or expected risk. Now, some people use a VAR estimate. Some people just use the annualized standard deviation of return. But we use the latter. One's exactly equal to the other. Just, they're multiplied by a scalar. So what you'll see here is the ex-ante risk, and then the annualized risk going back only 65 trading days. So 1 quarter, 3 months of time. Now, that's not a very long period of time. So you'd expect for there to be zigs and zags here. And as you could see, the recent numbers, are pretty scary. I've never seen the VIX do this. Actually, that's not exactly true. The old VIX in 1987, I think the intraday high was 156%. But it was like a dream. A couple days later, all that was gone. And the market started recovering. But for this VIX to go from 10 to 20, 20 to 30, back to 20, up to 95, and remain at 65 to 70 for the period of time that it's remained at, I've never seen anything like that. So any historically based covariance matrix is going to underestimate realized risk. And that's what you see there in terms of that red line being above the blue line. But what I point out to clients is, yes, we did underestimate risk, but we underestimated risk. It was 14% instead of 8%. Right? A lot higher than I would have expected. That proportion is higher than I would have expected. But at the same time, if you looked at these charts for most other strategies, this chart would be much more severe. And that's the feedback that we've gotten from clients. This is also the transparency that we give to our clients to show them realized risk based on daily data. A lot of them don't get that. They just get monthly returns from hedge funds. So they could get more high-frequency data from us. So that's the risk numbers. OK. Looking forward, I have a couple of things that we all know are true. And it says here 4 out of 5 dentists excuse me, surveyed recommend sugarless gum. 4 out of 5 average Joes will get more from Obama tax plan. And 4 out of 5 of investors think that the world's coming to an end. If you go out there, it is just downright scary. It is hard to find anybody who's bullish and acting on it. There are people who are bullish. Excuse me. This This is courtesy of my 10-year-old son. There are plenty of people who will tell you that you should be bullish, but outside of Warren Buffett, who structured himself quite a sweet deal, I don't really know of anybody who's acting on it. These are the scariest times I have ever seen as an investor. And to a lot of people who have been around a lot longer than me, these are the scariest times, arguably, since the Depression. Now, will it turn out to be another Depression? I don't think so. I'll talk about why. But please understand, these are quite unusual times. So let's look back and say what went wrong here. What happens when markets are doing well? People become complacent. So credit spreads coming down, people bought credit. You take a look at Bear Stearns, right, the famous situation there. And I have an awful lot of friends at Bear Stearns, including the guy who was running the firm, and ultimately, arguably, was responsible for all of this. They had a hedge fund that invested in mortgage-backed securities that at one point I think had 44 consecutive positive months. Somewhere around the point where it had 40 consecutive positive months, they came out with a second hedge fund, which was exactly the same strategy as the first, but levered 2-to-1. Now, if you're an equity guy, I think history tells us equities can't go up forever, but the numerator is variable when you look at valuations, earnings price ratio. Right? And you could convince yourself that equities can go up a long way before gravity brings them down. But in bond land, there's certain things that we know have a very high probability of being true. There is a negative serial correlation of historical returns to prospective returns. Bond yields come down, prices go up. I made a lot of money historically, but now all of a sudden bond yields are at 3% instead of 5%. Your yield going forward is lower. Right? So instead of having 5% plus a capital gain, now I have 3% going forward. Right? And as that happens over time, eventually capital figures it out and money floats away. Same thing's true with credit spreads. If you have a strategy that's based on credit spreads, or in this case mortgage spreads, collapsing, right, that'll work for a while, but they can't get lower than 0. And they're not even, obviously not going to get to 0. When they get below a certain level, the odds of them continuing to do well get less and less and less. So there was all this complacency. And of course, people who all they did was look at historical returns bought these hedge funds in droves. So everybody's blaming Bear Stearns. At the end of the day, it's almost like blaming General Motors for making trucks. Well, there's an awful lot of demand for trucks. Right? There's an awful lot of demand for things that weren't a particularly good strategy.
Just for my own assumptions, I talk about this a lot in class. People don't get this about bonds. So you bought mortgage-backed security, a hedge fund product, right, whose performance was outstanding, and that could only occur because the credit spread's tight. Basically speaking, as long as they were borrowing on a constant duration.
Yeah, I mean, they'll spin stories.
So, but I want people to understand this is a very great one. So if they have done very, very well, then that would have occurred because credit spreads would have tightened. And this is not a behavioral story or a market's going to mean reversion. This is a math story. If they have done well, then they are almost hardwired to not do well going forward.
Well put.
Yeah.
Absolutely right.
It just has to be that way.
Right.
And, hope people understand. That's kind of like a pet peeve.
Yeah.
And that's exactly what you're articulating, which I didn't realize was part of why people bought in those hedge funds in the first place.
Yeah, historical returns. So, and it really gets at the underlying theme, which is that most people don't understand what they're buying, especially in selling high net worth investors. And a lot of those funds were peddled through the high net worth distribution effort at Bear Stearns. So, what do we see here? We saw on the left side, you'll see the savings rate, and on the right side, you'll see credit spreads. So, savings rate chart looks pretty severe. Oddly enough, it's not as severe as what we saw in the 1990s in terms of the compression of the savings rate, but it did go from 2% to about 0, a little above 0.5% or so. Credit spreads, also, you see what happened to credit spreads. So high yield spreads when we were coming out of the recession in 2002 had blown out to over 1,000 basis points. All of a sudden, they're into 360 basis points, and everybody thinks that they're attractive. Right? Now, they're at 360 basis points because corporate credits had improved dramatically. But guess what happened as they got from 500 to 360? An awful lot of issuance. A lot of people looked up and they said, hey, I could issue bonds here and I can make a lot of money if I just invest that in my business. We're at 1,000 basis points spread, nobody was issuing bonds. So from a technical standpoint, you don't get a lot of supply of bonds when spreads are wide. You do get a lot of supply of bonds when spreads are narrow. So you had this tremendous compression of credit spreads across the credit spectrum. Consumers spent a lot of money. You know, this is what the good times all about. And you know, there's a famous line about the Fed that the role of the Fed is to take away the punch bowl once the party gets to be a lot of fun, right? And that's pretty much what happened. And if you take a look at what the Fed did, they raised short rates from 1% to 5.25%. I think they underestimated, I know they underestimated the severity of that set of decisions. You know, Bernanke took over when short rates were at 4.5%, ratcheted up 3 more times to 5.25%. So these guys never dreamed that the housing market would unfurl. They never dreamed that every bank and brokerage company would be so exposed to these very same mortgage securities that their capital would get eroded to the point that the credit markets would shut down and nobody be loaning money. Nobody saw that going forward. Not the Fed, not Treasury, you know, not me. So that was a surprise to the markets. You know, if you take a look back in the 1990s, we had a lot of strange things happen in the second half of the 1990s, which is that, you know, Clinton's first term wasn't so great from an economic growth perspective. His second term was terrific, leading up to the tech bubble, which, you know, led to the explosion of that and the global recession that we had starting in late in 2000. But if you take a look at the second half of the 1990s, an interesting observation is that volatility started rising. And it didn't rise smoothly. Right? The trough was somewhere in 95, 96. And then from April of 96 on, volatility started rising. And then we had the Asian crisis in 1997, and volatility spiked up and came back down. And then we had LTCM in 1998, long-term capital, volatility spiked up even higher. Russia exploded, and then it came down. And then volatility kept on going up. Now, over that whole time period, it was the best period for equities in the history of the country. So sometimes these notions we have, hey, risk is rising, this is bad for risky assets. It wasn't true for 5 years running. This time around, you know, we had the VIX starting to move up, we had some problems, and the magnitude of the impact was just enormous relative to what happened in the last cycle. So we saw housing default rates. That's a chart on the left-hand side. You'll see default rates. Delinquencies, I should say, have just about doubled, but that's a little bit misleading because what's really happened is that the concentration in subprime and Alt-A mortgage loans has been severe. Default rates there are as high as 20%. What you tend to see happen at the end of any cycle is that you get bad credits. So in the 1990s, as high yield spreads came in dramatically, we had an enormous amount of telecom issuance, which raised the percentage of the high yield, the telecom sector in the high yield index, from something like 6% to something like 26%. It became far and away the biggest sector in the high yield marketplace. Most of these telecoms didn't make any money. It was one of these tech stories. Remember, telecom used to be a utility, and in the second half of the 90s, it became TMT, technology, media, and telecom, to group them all together. So people bought into these stories. All of these bonds got issued by firms who didn't make any money. 18 months later, we started seeing defaults rise. In 1999, despite the fact that we had a very strong economy and a very strong stock market, high yield defaults just about doubled. Very strange happening. It was all because of the sectoral concentration. This cycle, the sectoral concentration was 06 and 07 mortgages. And what you find when you take a look at 06 and 07 mortgages was the sloppiest underwriting standards that you could find. You find people who lied very badly on the mortgage application. You didn't hear any of that during an election year, did you? Right? What you heard during the election year was, it's the bank's faults, it's the mortgage company's faults, it's the CEO's faults. That's who we've got to blame. Wonderful populist message issued by both parties. And my instinct about this is that one of the two people really who are at fault here is, number one, of the mortgage brokers who worked with individuals to get mortgages. And I'm talking about Alt-A and subprime. And number two, I think if you take a look at those mortgage applications in 06 and 07, you'll find that a large percentage of them have erroneous data. And as a result, what was happening was that people were moving into houses based on teaser rate ARMs that they can afford this year. And when short rates kept rising, the resets got higher. They figured at the time, what's the big deal? Housing prices only go up. If we can't afford to pay our mortgage, we'll just sell our house and make money. This is easy. And that no longer happened. So, so that's one problem. But the bigger problem for the economy wasn't 06 and 07 mortgages. The bigger problem for the economy was that mortgage derivatives and securitization was supposed to allocate risk in a sensible way so that nobody was too exposed. And what did we find out with the benefit of hindsight? Banks and brokers were extraordinarily exposed. I can't believe that these guys had the type of exposure to these securities that they had. I mean, 2000, you're talking about pet peeves. In 2001, I went to my bank analyst at Credit Suisse, and I said, every major recession, every major setback in the markets has been characterized by one financial services company blowing up. Find that one. And my bank analyst came back to me and he said, I hate to disagree with the boss, but I've got to disagree with you here. He said, if you take a look at what banks were doing throughout the second half of the 1990s, banks were trying to morph into investment bankers. They didn't want to be commercial bankers anymore. Securitization took away the easy money. So how were they going to make money? They wanted to get out of the business of risking their capital and into the business of generating fees. Because if you generate fees, if it's a bad year, so you'll generate less fees. But we're not going to lose our capital. And so if you take a look at the performance of banks in 2000 through 2003, it was spectacular. Far exceeded what anybody expected, given the economic climate that existed at that point in time. Right? Well, 5 years later, excuse my language, but look at how badly they screwed things up. They went from organizations that said, we don't want to risk capital, to organizations that risked an enormous amount of capital. Leverage of 30 to 1, getting back to leverage. And not only leverage of 30 to 1, but how much of that 30 was focused on the same common risk factor. Rule number 1, right? Diversified sources of alpha. They didn't do it. So when the housing market blew up, these guys lost a lot of money. Now, here's the next thing that has changed and changed dramatically. This is an important observation, I think, about the markets. If you go back 20 years ago, when hedge funds were pretty small, most investors were what I'll call value investors. Interest rates went up, they bought. Interest rates went down, they sold. Equities went up, they probably sold a little bit. Equities went down, they probably bought a little bit. Right? Even though there was lots of volatility, and the economic fundamentals were much more volatile then versus recent history, what you find was that the behavior of investors was probably more settling than it was disturbing in terms of its impact on the markets. Now, have you guys gone through portfolio insurance? Okay. All right. One of my professors in graduate school, Mark Rubenstein, John Cox, another guy I've known for a long time, and Robert Merton, a lot of other people, these guys figured out that an option, any option, can be replicated by a dynamic combination of the underlying asset and cash. And as the price of that asset moves, the so-called hedge ratio moves. And if you continuously rebalance to this new hedge ratio, you will perfectly replicate the return distribution to this option. Okay? So people named Hayne Leland and Mark Rubenstein, and a guy named John O'Brien, put together a firm called LOR, and they went around and they said to everybody, get rid of your bonds. Why do you have bonds? You have bonds for one reason, which is an anchor to windward. You have bonds because if equities are going to do poorly, bonds won't hurt you. Pretty good sales pitch. We have a solution to that problem. Put more money in equities and let us replicate a put option so that you can only lose a little bit of money. So that if equities really fall out of bed, you're not going to lose more than 5 or 10%. And if you take away the worst case scenario with equities, probably feel a whole lot more comfortable with equities. These guys ultimately had around $100 billion in assets. JP Morgan was in the business. Everybody was in the business. And different people did it different ways. At JP Morgan, we incorporated live options to hedge our delta and our gamma and our vega, whereas LOR replicated options because that was their raison d'etre. So lo and behold, October 19th of 1987 comes along. Right? Equities drop, they have to sell. Equities drop, they have to sell. Equities drop, they have to sell. And as they sold, it put more selling pressure on equities, brought equities all the way down. Right? Now, when you replicate an option, the premium that you end up paying for that option is a function of realized volatility. Whereas if you buy an option ahead of time, you lock in the implied volatility. So all of a sudden, the cost of that option went from this to this. So if they told somebody your worst case scenario is -5, all of a sudden people lost 10, 12, 14% because they couldn't rebalance fast enough. And they churned up so much money because of so much volatility. Right? Again, the VIX went up to 156% for that day on October 19th of 1987. But the bigger issue was, what caused the equity market to go down this much? Right? And there was a whole commission that was set up by the president. I forgot exactly who set up the commission, but we had somebody from JP Morgan who was on it. People from every major firm was on it. And what they concluded was, yeah, you know, if you got hundreds of billions of dollars that are selling something after it's gone down, chances are it's going to go down some more. All right. That strategy fell away. Some people still do it, but very, very shortly. Now, let's fast forward. Hedge funds. How do hedge funds manage risk? Hedge funds are absolute return investors. What absolute return investors means in simple parlance is limit your downside, let your upside run. How do you do that? Well, I've got an investment. It's making me money. Fine. Let it keep going. I've got an investment. It's losing money. What do? Sell it. So most of them use stop losses, which are analogous but not exactly the same as an option. But when put together in a portfolio context, it's no different. Most hedge funds have as their core risk management discipline the process whereby if they're making money, they'll add to positions to a point. They won't keep on adding. Right? But if they're losing money, they'll be selling positions. Right? So what's happened as of late? Right? Markets went down. They lost money. And not just the markets went down, but they lost money on their trades. When they lose money on their trades, what do? Take their trades off. They take their trades off. It pushes those trades further in a negative direction. Now they've got to take more off. And we see this in convertible arbitrage. We see this in equity long short. We see this in global macro. We see this in every major discipline in the hedge fund world. Now, when hedge funds were $100 billion in the 1990s, it wasn't such a big deal. Yeah, maybe they pushed the market around for a day or two, but it wasn't such a big deal. Now, all of a sudden, hedge funds are $1 trillion plus. And now we have this dynamic in the market where all of a sudden the market's going in one direction, people are losing money, and their risk management disciplines pile on, force the market to keep going in that direction.
Just a quick question on that.
Yeah.
The difference between the current hedge fund environment and the 1990s, and I agree with you that it's obviously been, they've all sold at the same time. That's why they're all very bad. They have all some good markets that propel to their side. Is it true that the hedge funds on average are more leveraged than they were back then? So part of this selling may not be a stop loss. You think it's all just there's
Oh. I think, on average, hedge funds are far less leveraged than they were back then. And here's the reasons why. Remember that asset class, or that fee, I think Cliff's words were a fee schedule masquerading around as an asset class. Right? That's what he talked about with hedge funds. Well, you know, I have some friends who run enormous hedge funds. If you have a $10 billion hedge fund and somebody's paying you 2 and 20, right, that 2 means you get $200 million a year in management fees. Job one is not to screw up. And I think if you take a look at most equity long-short hedge funds, the level of leverage is a lot lower than it was in the 1990s when you had to have outsized returns to attract capital. Right? So, but having said that, that's offset by the fact that there's 10 times as much as there was back then. So that's what's going on. Now, you want to hear a worse part of this story? What made it worse? Okay. Who were they trying to sell to? Who were the middlemen that were making markets? Who were the over-the-counter specialists? Ooh, those are the same people who lost so much money through the mortgage debacle that they weren't willing to risk any capital on their desk, on their trading desk. So now all of a sudden, somebody loses $1 billion in a $10 billion fund. I got to get out of these trades. He calls up Goldman Sachs. Well, bad example. Let's say he calls up Citi. Right? And he says to the people at Citi, he says, I need bids on this and offers on this. The guy from Citi says, holy shit, I'm not going to take this type of position. Right? Now all of a sudden you got nobody to sell to. So the whole role of a specialist, we know about specialists on the New York Stock Exchange, but at the end of the day, the guys who are responsible for making markets in the over-the-counter markets were de facto specialists. And they took a powder. They got out of the business. They didn't want to risk capital anymore because they had lost so much of their capital base. So we had a pretty bad situation. We had people chasing markets down and nobody to sell to, and that's how we're down 40% in a year. Okay, I got something from Deutsche Bank recently, which I thought was whimsical, if nothing else. I am not a big fan of very long-term data. With all due respect to Roger Ibbotson and Rex Sinkfield, I do not believe that equity returns in 1926 are helpful at all in forecasting returns in 2009. I tend to view historical data with an exponential weighting scheme. So I'll go back to, for equities, I'll go back to the 70s, maybe even the 60s. Right? Won't go back before the 60s. For bonds, don't go back before the 70s. Right? For my model, I only go back to 1985 because those time periods that I just mentioned are valid for the US and nowhere else with the possible exception of the UK. Having said that, people find data in different places. And Deutsche Bank found data going back to 1919 on credit spreads. I don't know about the veracity of this data, but it is interesting that if you take a look at what's happened to credit spreads recently, it's the worst thing that's happened since the beginning of the Depression. So pretty bad stuff going on out there. So let me, if I can, almost end, this is the penultimate side, with reasons to be optimistic, because there's every reason to be pessimistic. There's every reason to be scared. And history sort of suggests to us that, of course, that's probably the best time not to be scared and not to be pessimistic. So number one, valuations have become compelling across virtually all risky assets. Now, I say that with tremendous confidence in the credit markets. I think if you could buy a high-yield index with a spread of 1,500 basis points, you're going to make a lot of money. Could it go to 1,800? Sure. Could defaults go to 15%? Sure. But defaults aren't going to go to 15% and stay at 15% every year going forward, and that's what 15% yields tell you. Not this year, every year going forward. They're going to average 15%. I don't think that's going to happen. So tremendous confidence there. On the equity side, a little dicier. It's easier over in the UK, where multiples are 8 times this year's earnings. It's harder in the US, where multiples are 11 times this year's earnings. Still looks cheap, but if you believe that we're going into a Japanese-style recession that's going to last a decade, probably not going to make a lot of money with equities. I don't think we are. And that gets us to the next point. The Fed has moved fast and hard, arguably more than ever before. I have never seen a Fed do what this Fed has done. And with the benefit of hindsight, Bernanke was the perfect choice, because Bernanke did all of his academic work on how to avoid deflation, how to avoid the mistakes of the 1930s. So not only did he bring interest rates down from 5.25 to 1, 1 is a mythical figure, incidentally, because no trading's taking place there. It's actually about 30 basis points. So, he's brought basically interest rates down to 0. He's talked about quantitative easing, flooding the system with excess reserves. He's done things in terms of auctions that I've never seen a central banker do. He fully recognizes how bad the situation is and how immediate the necessary actions are. The government, same thing. Now, Paulson has not distinguished himself. I think this latest announcement that he wants to change directions, whether it's right or wrong, places a very large seed of doubt in investors' minds. What investors would love to hear is that Big Daddy's going to fix it all. And Paulson's come back and basically said, I may have gotten something wrong. Let me take that 350 and move it over here. You guys won't mind, will you? So with that, the government's doing an awful lot. Now, this fourth bullet point, I can't emphasize enough. I believe that a big source of the problems that we're seeing, not only in the US but in the world, relates to the fact that for a full year, the only one doing any heavy lifting was the US. So while Bernanke's cutting interest rates as fast as he can, while Paulson's scrambling around to find money that he could throw out into the credit markets, while Pelosi's finding money that could stimulate consumer spending, right? The ECB raised interest rates as recently as July. What are those guys thinking? Right? In July, they raised short rates from 4 to 4.25. July, 4 months ago. these problems were there 4 months ago. What was he thinking? Anybody have any defense for Trichet? Well, I wouldn't disagree with that. But here's where the fundamental fault occurred. There is a philosophical chasm on the issue of inflation between the US and Europe, including the UK and including many other places. The US says we look at core inflation. Right? We don't look at core inflation to make monetary policy decisions because that's the best barometer of what actual inflation has been over the last year. Over the last year, the typical consumer realized an inflation rate of about 5% on the goods they purchased. Right? We use core inflation, which was 2.5% over the last year, because it's the best indicator of where headline inflation will be over the next 12 months. And at the end of the day, the last 12 months is spilled milk. We have no interest in changing the past, nor can we. Monetary policy is there to determine what future inflation should be. And by controlling future inflation, you will maintain some semblance of rationality in the marketplace. Okay? So that's what Bernanke says. The Bank of England beat him up. You know, the Brits are very good at debating. And they beat him up at one of these big meetings that the central bankers had a couple of years ago, a year and a half ago. And they said something which seemed pretty logical at the time. Here's what they said. They said, if you take a look at the growth dynamics around the world, the growth dynamics around the world are as follows. Okay? This is what's going on around the world. China, a little bit less India, but let's just pick on China for a second. China is growing at 12% a year. Okay? They got 1.3 billion people. They decided to industrialize. All this infrastructure is being built. You know, all this, their economy is growing dramatically. And as a result of not only their growth, but the areas that they're growing in, we're seeing tremendous upward pressure on commodities. At the same time, it's exactly that growth which has led to lower goods prices in the U.S. Now, how's that possible? What's the whole dynamic been for the U.S. over the past decade? Let's import cheap labor from China. We're going to outsource production to China. Right? They make 10, 12% of what a U.S. worker makes. Pretty good deal. Now Walmart can sell goods cheaper. So everything that's not commodity related or energy related, right, is a lot cheaper than it used to be, or hasn't gone up much in price, let's say. Right? Core inflation has risen recently, but it's only risen at 2.5%. Right? Energy prices went through the roof as oil went from 30 to 147. And based on our estimates, over the last year, ballpark numbers, 5% headline inflation, 2.5% core inflation. 80% of that difference between headline and core, which turns out to be 2.5% also, is traceable to energy. Right? So Bank of England says, how could you construct your policy taking into account the good things of Chinese growth and at the same time ignore the bad things about Chinese growth? Okay? Pretty good argument. They're good debaters. They're wrong. The whole idea behind core inflation is that food and energy are very volatile things. And if they become a problem, we'll see it in core inflation rising going forward. In the 1970s, headline inflation was above core inflation when energy spiked up. But check out core inflation. Kept on going up and up and up. The incipient inflation pressures in the 1970s, which came from oil, were allowed to remain in the economy. Whereas in the 1980s and the 1990s, Volcker and Greenspan figured it out. Higher oil prices are a transfer price. We're not going to inflate the whole economy in order to accommodate higher oil prices. If oil prices go up, something else has to go down. It's monetary policy's job to make sure that the overall inflation rate remains reasonable. Right? So that's why we had this negative correlation of oil prices to interest rates. Just the opposite of what we saw in the 1970s. Right? Well, what's happened to oil here? What's happened to oil, very simply, is it's gone from 147 down to 57. Probably going lower, 50, 40, whatever it is. Right? Chinese growth, I don't know if you saw the recent announcements coming out of China, but what they basically announced was the biggest stimulus package in the history of economies. It was 15% of GDP spread over 2 years, 7.5% per year. Little misleading because some of the stuff had already been announced and they incorporated it. They sort of counted it the second time. So it isn't all new, but it is all fiscal stimulus. Right? And with that, they said, this way we'll be able to keep growth at 8%. Well, what happened to the 10 and 12? India's a mess. Right? Take a look at the Indian rupiah, in bad shape. You take a look at emerging markets around the world. Things are not good right now. We are in a global recession of a pretty significant magnitude. And as a result of that, demand for oil, which was higher than the supply, probably is equal to the supply, if anything below. But all of that speculative run-up in oil, which came from all of those people who bought oil futures because they knew it was going to go up, whether they were hedge funds or whether they were people hedging future purchases, they've turned and run. And so now, if you go forward and you say, where's headline inflation going to be over the next year? Right? You know what I've been telling clients? And I'm just now starting to hear some people talk about it. By next summer, the trailing 12-month inflation rate in the US, in the UK, in Europe, it's going to be about 0. If I'm wrong, it'll be 1%. It only stands to reason that if headline inflation was above core inflation because of food and energy prices, that when food and energy prices do a round trip, then headline inflation has to be below core inflation. People aren't really factoring that in. That'll help bring interest rates down. That'll help steady the markets. So that's that. Now, what does that have to do with this fourth point? Trichet is still banging the table about second round effects from higher oil prices. Right? I don't know what he's thinking. The Bank of England said the same thing 2 months ago. The Bank of England last week said, well, we sort of changed our minds about that. And instead of lowering short rates 50 basis points, we're going to lower them 150. 150 basis points? Wow. I've never seen that happen. Bank of England, I think somebody said they once did it several decades ago. So with that, we're now at the point where it's not just the Fed doing the heavy lifting. UK has recapitalized their banks. The Bank of England's cut rates and is likely to go further. Euroland, Trichet's got to turn around. He's cut rates a little bit. Now we have this G20 meeting. It's pretty clear that their rates are coming down. It's pretty clear that they're going to have to stimulate their economies. We've seen it in Australia, an economy that's holding up better than all the others. They just had a $6 billion bailout package to their auto companies. So around the world, we're seeing foreign governments who now get the joke. They now understand what's going on in the world. They now understand that they have to act. They need to act now, and they need to act in a big, big way. So that ultimately will work. Doesn't work overnight, but it will work. Here's the last thing, which is the commodity bubble bursting. Remember those 3 bubbles? Right? The commodity bubble bursting, that's a good thing. It may not be good for Russia. It's certainly not good for Iran, but it's very good for the U.S. Brings inflation down. Take a look at what's going to happen to our trade. I don't know if people saw the trade deficit number improved by $3 billion. Right? Got to sift through the numbers. I think it said that oil was priced at $108 on average in September. And it reduced the oil-related imports by $9 billion. Well, now take 108 down to 58. It's probably another $18 billion coming right off the top on our trade deficit. So remember the trade deficit that was never going to go away? It's going to get pretty close. So with that, there are some reasons to be positive, but that's not going to stop me from being scared to death every day that I go into work.